And if you want to change this from a dollar value of silver to a contract value, you would multiply your silver contract by 5,000. Perfect. We know how to do that. We know how to do that. Okay, so we can obviously see that silver has some crazy good levels. You can see, of course, there's a crazy good level up here. Swing highs, just like every other market on the planet. We see some crazy good tradable levels for level 2 stuff and for everything else. But the good thing about silver is something that Paul loves. I'm surprised Paul hasn't become a natural silver trader. What does Paul love? Even more than slagging Americans, what does Paul love? He loves liquidity grabs. He loves trading liquidity grabs, doesn't he? He loves his ice cream beaches as well, Sam, absolutely. But he loves these liquidity levels. He loves getting into that top edge and that bottom edge. Remember the old discussion before about liquidity, and Paul was we were talking about that, and says one of the things that we were talking to Paul about specifically was you're not always going to get that top edge in gold. You're not always going to get that bottom edge in gold. You do on silver. You do on silver. You get most of the top edges and the bottom edges in silver because of the volatility in silver and the need for liquidity. So when you're trading silver, you very rarely cross the spreads to get a silver contract. Very rarely cross into those trades. Now let's take a look at how this trade evolves. This is a 5-minute silver chart, and you can see silver very, very similar to almost exactly the same as what gold has been doing. But just take a look at the bottom edge, for example, here. Did gold take out the low of the bottom edge? Was gold one of the markets that took out the low price of the bottom edge, Paul? Well, I'm assuming that everybody knows the answer to that, just nobody's typing it in. The answer is no, it didn't. So I'll just fill it in for everybody. So gold did not take out the bottom edge, silver did. So if you're like the type of trader that likes to see the liquidity being grabbed and then to deal, making it safer for you as a trader, you wouldn't have got the gold trade long, would you? You'd have been having to cross into certain trades to try and grab that long gold play. And for that reason, you didn't get the level 2 liquidity that you'd have wanted, but you did on silver. You got the level 2 on silver. You got the level 2 on silver. So when we look at this against things like the real yield market, so for example, we can look at real yields the same way as we look at real yields on the gold market as well, where it has the same quality about it, CL1 against the 10-year yields. And if we look at real yields, obviously it's also valid when the yields are closed. We can already recognize the same things are visible on silver as they are obviously on gold. It makes perfect sense. This is a very, very strong positive correlation. We can see there's a vacuum running down through this area here, so we always... Well, let's just ask you the question. Where would you mark your supply from on this chart? Where would you mark your supply from in this chart, guys? Where do you draw your supply demand? We've covered this in classroom before as well. Let's see if anybody paid attention. Where do we always recommend you draw your supply demand from? There's a couple of things, of course, that we always suggest that you do. I mean, you could do the POC, couldn't you? You could mark off the POC. But you generally, as a rule, draw supply from the low of the last green candle. Has anybody remembered that? Does anybody remember that concept? The supply usually gets drawn from the low of the last highest green candle. It's got to be a significant candle. It can't be a little spinner candle, because that's obviously the reversal that's taken place, right? It's been that big candle that's been reversed. Nobody remembers that. What the hell is wrong with people? Okay, so we've done this in class many times. So the supply would be drawn in from that big green candle there. So your supply line would be that price. Well, isn't that exciting? Because on the basis that supply gets drawn in from that price, we can see that we get a level 2 seller coming into that price, and we get a second level 2 seller coming into that price. That gives you your 2 sell trades on the silver market there and the silver market there. Top edge, take out the highs, and the sell comes off that top edge print. It runs into this reversal trade narrative here. We clear the vacuum that was these two candles here, and we get all the way down to the day's bottom edges for a buy trade. Buy trade. Right there. It's crazy, isn't it? But we already know that this is a laggard in some respects, because obviously it's a low volatility, it's a low volume, high volatility market in comparison to the likes of gold. So obviously when I look at it against the gold-silver relationship, in this case, of course, we're reversing the gold-silver relationship to make it silver-gold, to make it positive, what we would imagine to make it positively correlated to silver, because we know that this is what's happening. Any higher highs against this or any lower lows against this could be a realistic opportunity to make some money. Anytime it's not doing that, perhaps there's an opportunity to trade gold on the other side of it. But anyway, let's see what happens. Does anybody see the opportunity to sell silver? It's pretty brutal, isn't it? It's pretty brutal. So we can obviously see there's a little short-term popper here, but even that short-term pop to the upside here, that little pop here, that pop stops at what price? Well, let's take a look at where that price, when that pop stops just there. There it is right there. There's the pop stop right there. Anything above that becomes almost a guarantee that you're going to be able to make money selling gold, aren't you? So you look to the left at that stage and say, right, where's the levels? Where am I dealing? And you start finding some key levels in the background, some higher highs, some higher lows, areas in this area here, into this area here. You see where all the stops are. You've now got your absolute guaranteed sell trade. What do you need now? What do you need now? You need silver. And you need a lean candle up here for silver, haven't you? You've got to try and get that trade on your books. Essential. And the good thing about these types of trades is because it's the thinner, skinnier markets, order flow stands out better, doesn't it? Now I don't have a silver trade. I don't have a silver chart set up, so I don't trade silver outrights. I always trade it as part of a spread, but I'll put a silver chart together and we'll come back to this in classroom. So welcome in, guys. Welcome in. Well, they can't trade otherwise, Paul. They can't cross the spreads. There's not enough liquidity to cross the spreads, is there? So they can't cross the spreads. So what the hell are they supposed to do? They've kind of really got to wait for that trade to start evolving, haven't they?